Alright guys, so in this video, we're just going to be continuing the calculation of the ratios that we did on the income statement, but instead we're going to cover some of the ratios on the balance sheet. So before we start calculating the ratios, the first thing that we're going to do is similar to the income statement, we're going to go to Apple's balance sheet and effectively transfer over all of this financial information onto Excel. So the steps to do that are exactly the same as the ones we used to build the income statement. So we write down the years here, and then we mention the individual line items here, and we effectively follow pretty much the same terminology that Apple has mentioned on its balance sheet. So you go in individually one by one, just copy paste the data over, shouldn't take you too long, but your end outcome should be something which looks like this. So before we start calculating the ratios, I would recommend that you spend the 10-15 minutes it takes just to copy the financial information over so that it'll be easier for you to go along when I'm calculating these ratios here. So, but once you have transferred this data over, these are the steps that we're going to be taking. So first thing that we're going to do is, so once we have transferred over all of this financial information, let me just spend a minute to recap some of the information that we learned in the previous course. So when we think about a company's balance sheet, it's split into assets and liabilities, and then we've got a common equity line here. And the basic idea behind the balance sheet is that the net worth of the company should be equal to the value of the assets or the value of the resources that Apple owns, and we reduce from that the total liabilities or the total money that Apple owes to different investors and all the different companies and people. The net number should give us Apple's total net worth. And the way the balance sheet is constructed is we list down the assets first and then the liabilities, and within the assets we mention the current assets first, then we mention the non-current assets, and similarly within the liabilities we mention the current liabilities first and then the non-current liabilities. I'm hoping that you would remember this. I'm hoping that you would remember this from the previous course, but if you do not, just feel free to pause and go back into the last course to cover this off. But with that being said, let's look at some of the items that I've listed here, which are super important, but are not made completely explicit on the balance sheet. So let's start off with total debt. So the amount of total debt on Apple's balance sheet is going to be the sum of the total current term debt, the total current commercial paper, and the total non-current term debt. And then we effectively just transfer over this formula to the following years. Now, this gives us the total amount of debt that Apple has on its balance sheet on each of these years. And it's the sum of the total short-term debt and the total long-term debt. Now, what's net debt? Net debt is effectively the total debt minus the cash and marketable securities that Apple holds on its balance sheet. So how do we calculate net debt? All we do is we look at the total debt number, and from that we take out the total amount of cash and marketable securities that Apple has on its balance sheet. Why do we take out marketable securities? Because marketable securities are cash-like in characteristic. If you recall, marketable securities can be very quickly liquidated and turned into cash. And so for our purposes, when we calculate the net debt, we take out both cash and also marketable securities. Here, we've got the total amount of net debt, and similarly, we're just going to transfer this formula over. And there we go. Now, let's look at the next item that we have here. It's called total capital. And what's total capital? Total capital is the amount of funds which are invested into a company by the company's investors. And so if you take a step back, what are the main sources of a company's capital? When a company wants to raise money, there are two things that it can do. One, it can go and ask for debt. So it can go and ask a bank or any financial institution for debt, which it'll have to repay over a number of years. And the second thing that it can do is give an investor a part of its company, also called equity. So in order to calculate total capital, all we do is we take the sum of the total debt and we add to it the total common equity in the company, and that gives us the total capital number. And we similarly transfer over for the following 2 years. And now this is a great step for us to go in and calculate the key financial ratios. Okay, great. So let's get into this. So the first ratio that we have on our balance sheet items is called current ratio. And what does that tell us? I've added a little tab here, or a column with definitions of all the key ratios that we will be calculating. The current ratio is effectively the value of all of a company's current assets, and we divide that from the total current liabilities. So if you think about it intuitively, what this number is telling us is, from a liquidity perspective, is the value of all the current assets that Apple has more than the amount that it owes to its investors? If the value of Apple's current assets is less than the value of its total current liabilities, that over the next 12 months, there is more money set to go out of Apple's bank accounts than there is money which is going to come in. So let's see how to calculate this ratio. Total current assets is mentioned here on the balance sheet, and we divide that by the total current liabilities, and that gives us this ratio. Now, what is this effectively telling us? What this is telling us is that the total value of Apple's current assets is 1.54 times the value of its current liabilities, or it's almost 54% higher than Apple's current liabilities. And so Apple is in a relatively comfortable position when it comes to funding all of its liabilities that are due over the next 12 months. Now let's look at these ratios here. First one we have here is total debt to equity, which is typically called gearing. Now, what does this ratio tell us? This ratio effectively tells us the funding mix that Apple has used when it raised money from the financial markets. So total debt to equity is effectively you taking the total amount of debt that Apple has on its balance sheet and dividing that by the total amount of equity. And then you copy this over. So what does this tell us? If you have a look at the evolution of this number, it seems quite clear that Apple historically has been using more equity in its business, or has been effectively raising more money in the equity markets than the debt markets, but it has progressively gone and used more debt to a position where it actually has 1.19 times more debt in its capital structure than equity. what we're going to do is, in a future course, I'm going to go over the specifics of a company's capital structure and explain to you why a company would do this. What we need to understand is that this ratio effectively gives us the funding mix, and it tells us how much debt and how much equity Apple has used in its capital structure. In summary, though, the reason why this ratio is important is, one, it gives us the funding mix that the company has used, and two, it explains to us that from the perspective of a credit investor or a company that has given a loan to Apple, this is a very important ratio because it tells the investor or the bank which has given money to Apple that effectively Apple has a lot more debt in its funding mix than equity. Now, why would this matter to a bank? This would matter to a bank because they want Apple to diversify its funding sources and not to be completely reliant on debt in order to run its day-to-day operations. Because what that effectively does is that it increases the risk that a bank is taking on Apple. If Apple has raised a lot more funding from the equity markets, then there's less of a burden on the debt investors, which is why this is a ratio which the company's lenders look at very carefully. The total debt to total capital is another ratio which is very similar to the one above, and it's calculated as total debt divided by total capital. And once again, we will transfer this over. So what this is telling us is the funding mix again. So Apple has 54% debt in its capital structure, and the remaining 46% is equity. And if we have a look at the evolution of this ratio, we see that in 2017, Apple had 46% debt in its capital structure, and this has progressively increased to 54%. So this is another ratio which is very important from a company's bank or lender's perspective. Now, why is that? What this ratio is effectively telling a bank is the amount of earnings that Apple has in a specific year. How does that compare to the amount of interest that Apple has to pay in a given year? Now, if you think about it logically, if Apple's earnings or its EBITDA is much higher than the amount of interest that it needs to pay, then it's good. It basically means, or it implies, that the lenders are in a much more secure position than if we saw that the amount of total interest expense was much higher than the EBITDA. That's not a good position to be in if you are a bank lender or if you are a company that's lending money to Apple. So let's calculate this ratio. EBITDA, if you remember, we calculated from the income statement in the previous video. So let's do that here. EBITDA divided by interest expense. Now we're looking at the interest expense here. If you remember, in the previous video, I spoke about why I was breaking down the other income / expense line. Now this is the reason for it, because when we calculate the interest coverage ratio, we need the EBITDA and we need to divide it by the interest expense. So I'm going to take the interest expense, I'm going to take the negative of this number. So when we do this, we get 21.39 times. Now let's transfer this over. So what is this telling us? What this is effectively telling us is that if you look at 2019, Apple's EBITDA covers its interest expense by 21 times, which is a massive number. This effectively tells us that from a lender's perspective, Apple is a very good company to be lending to because it's a very stable and secure company. You're very unlikely to be in a position where Apple will have less money than the interest that it needs to pay in a given year. So the next ratio we're going to look at is the total debt to EBITDA, also called the gross leverage ratio. This is a very important ratio that the financial community looks at, and in effect what it tells us is if you take the ratio of the total amount of debt on a company's capital structure, and if we divide that by its earnings, it gives us a sense of how comfortably placed a company is. So just to give you a sense, typically investors would be extremely uncomfortable if this ratio was extremely high. So let's say if this ratio was greater than 5 times, what that would effectively tell you is that the total amount of debt on a company is more than 5 times the earnings it generates in a given year. Now, that's not a very comfortable position to be in. But when we see here, if we look at the total amount of debt and divide that by the EBITDA for Apple and drag this over, we see that it's only 1.4 times. And this is a very strong number from a company's perspective, because what this effectively tells you is that it would take Apple less than 1.5 years to fully pay back the debt that it has raised from its investors. The net debt to EBITDA ratio is very similar to the gross leverage ratio, and it's called net leverage. But all we're doing here is that we're looking at the net debt, which, if you remember, is the total debt, and you take out all the cash equivalents and the marketable securities. So what this ratio is telling you is that when we think about a company's leverage, there are two ways to pay it down. One is the company's earnings, and two is the amount of cash that it already has on its balance sheet, right? So when we look at the total amount of net debt that Apple has, which is quite small if we compare it to the total amount of debt that it has, and if we divide that by the EBITDA, this gives you the net leverage ratio. And what this tells us is that, taking into account the amount of cash and marketable securities that Apple has on its balance sheet and the amount of EBITDA that it generates in a given year, Apple's lenders only need 0.1 years to actually be paid back, which is effectively a very, very short period of time. And again, a very good signal from a lender's perspective.